Hi friends, welcome to the channel JIV and CIV Made Simple. This is our unit number 15 theory portion of ABFM, and the chapter name, as you can see, is other non-DCF valuation model. You know what is the meaning of DCF? DCF stands for discounted cash flow method, which we have learned in the unit number 14. We have discussed in detail about it. So let's see what are the topic which we have to study. First of all, we will see the introduction, we will see the relative valuation model, we will see some equity valuation multiple models, and enterprise value multiple model, choosing the right multiple, book value approach model, and stock and debt approach. So let's get started with our first topic, which is our relative valuation model, which is introduction. So friends, have you ever wondered how companies are valued? Have you ever wondered it, that how do we do the valuation of company, right? So imagine you are buying a shop. Suppose you are buying a shop. You would not just pick a price randomly, right? You would look at its sales, profit, and even compare it with a similar shop. That is exactly how business are valued, and today we are breaking down in the simplest way possible. So when it comes to valuation, there are two major ways to do it, right? When it comes to valuation, there are two major way to do the valuation. The first is called DCF method, you can say discounted cash flow method, and the second is called non-DCF method. So what is the meaning of DCF method? DCF means so DCF focus on future earning, right? DCF focus on future earning and cash flow. It's like saying how much will this shop earn in next 10 years and what is that worth today. So if you see the cash flow over the next 10 years and you find the present value, that is what DCF is all about. And if non-DCF is like that instead of looking at future cash flow, so in DCF what we look at the future cash flow, but in the non-DCF we don't look at this future cash flow, right? We don't look at it. Rather, these method use other way to estimate a company value. What is the other way? Think of it like comparing the shop price with other shop or checking it asset, right? So in earlier video we covered our DCF model in detail, but today we will focus on the non-DCF model, which includes some method like relative valuation model. So in relative valuation model, what we do, we compare, right? Comparison is done. We compare a company value with other in the same industry. Then we have equity valuation multiple model, where a deeper look at how much the entire company is worth. Then we have actually it is enterprise value. Equity value, we look at the key financial ratio to determine the value. There are some ratio we will talk about, we will discuss in detail. I am just giving you a overview. So equity valuation, we discuss the ratio. In enterprise value, it is basically a deeper look at how much the entire company is worth. And then the book value approach, which checking a company net worth based on its assets and liability. In book value, we check the company asset, we check the company liability, and then we decide what is the net worth of the company, which is called NW. And finally the stock and debt approach, which evaluate a company based on both its stock and debt. So each of these method gives a different perspective on valuation, just like checking a shop price based on location, sale, even the number of customer. In the next part we will break down these one by one with real world example, so stay tuned. So now let's discuss each and every part. Let's start with the first method that we have, is regarding the relative valuation method. So friends, imagine you are buying a house. Would you pay any random price the seller asks? Of course not. You would check how much similar house in the area are selling for. That is exactly how this relative valuation model work in business valuation. Today we will break it down in the simplest way possible. So relative valuation, you can think of like shopping smart. You can think of it like shopping smart, means you compare the price of one thing with similar thing in the market. Instead of calculating an asset value from scratch, we compare it with similar asset that have been sold recently. So how it work? So the first method is a comparison method, which means we compare a company value with similar company in the market, just like comparing house price in the neighborhood. Second method, we have indirect valuation. So sometimes it is hard to directly calculate the value of an asset. Yes, obviously to some asset it is very difficult to calculate the value, right? So instead of guessing, we look at what similar things are worth and adjust accordingly, right? So we rely on comparison. So we look at what similar things are worth. Let me write down. See, this is a key point. What similar thing are worth. We look at what similar thing are worth, and then we adjust accordingly. Then the third method we have is behavioral insight. So Dan Ariely, remember it, Dan Ariely. So he was a behavioral economist. He say people don't think in absolute term. We judge value by comparing. So this is the key point. We judge value, people don't see in absolute term, rather we we judge value by comparing, whether it is choosing a job salary, choosing a job, whether it is choosing a salary or phone or even a stock price. We value is done by comparison. We don't see the absolute thing. So that is called behavioral insight. And the final technique we have is called market based pricing. So it is common sense, if two things are nearly identical, their price would be close. If one is much cheap, it is either a great deal or something is wrong with it, right? Two things are there, market based pricing. So basically these are the methods. First methods is comparison method. I just like shopping smart. Indirect valuation means what similar thing are worth in the market. Behavioral insight means value by comparison. And if we talk about the market based pricing, so it means suppose two identical things are there, so it means that their values would be same, their price would be same. But if there is a huge change in the price, huge difference in the price, it means either two things, either it is a great deal, or there is something wrong with the product. So that is the point. For example, let's say you want to buy agriculture land. Let me give you an example to make things clear. Let's say you want to buy agriculture land, right? And you check the price of recently sold land in the same area. If one plot is priced at rupees 10 lakh per acre, if one land is priced, if one plot is priced as rupees 10 lakh per acre, so another similar plot is rupees 12 lakh per acre, right? And you get a fair idea of what your land should cost. So this same logic apply when valuing company. So sounds simple, right? So relative valuation is one of the easiest way to estimate a company worth. So in the next slide we will discuss some more method, right? If you found this useful, hit that like button and subscribe for more such insight. Now let's talk about what are the steps involved in relative valuation. So imagine you are buying a second hand car. Suppose you are buying a second hand car. Would you just look at the price and make a decision? Of course not. You would check the brand, you would check the condition, you would check the mileage, you would check the engine power, and even compare it with similar car before deciding its worth. That is exactly what we do in relative valuation when analyzing a company value. So when valuing a company, we don't just randomly compare price. Rather, we dig deeper and analyze various factors. Let's break it down with simple steps. The first step is that we see the industry position, we see the financial health, right? So what is the industry position, what is the financial health, which means like just like checking a car brand reputation, you check the car brand reputation, right? You check the car brand reputation, right? So similarly, we analyze where the company stands in its industry and how financially stable it is. Second thing we look at is the product and market scope. You see this product and you see this market scope. So what product does the company offer? Which customer does it serve? Is it a Nike player or is it a market leader? The broader the reach, the strong the valuation. Obviously, the more the reach, the strong the valuation. Third thing is cost availability, right, of raw material. Cost and availability of the raw material. Means you look at the pricing, that is the cost. You look at the availability of the raw material. So a company that gets its raw material at a lower cost has a competitive advantage, just like a restaurant that gets cheaper fresh produce, right? So basically these are the points based on which relative valuation is done. First of all we see industry position and financial health. We see the product and market scope. We observe the cost and availability of raw material. Then we see that technology and manufacturing strength. You see this word written here, technology and manufacturing strength, which means that a company with cutting edge technology and efficient production facility has a higher competitive edge. Think of it like a smartphone brand. You can think of like a smartphone brand, right? So with advanced camera technology. Then we have some brand reputation, right, and customer loyalty. That a company with a strong brand recognition, wide distribution, and repeat customer will always have an upper hand in valuation. Then we have something called competitive landscape. You see this word, competitive position, competitive landscape. How does the company compare to rival? Is it unique or it just another player in the crowd? So a business with USP, what is USP? This is called unique selling proposition. So or we call it unique selling point. So a business with a USP will be valued higher, right? So that is called competitive landscape. Then the next point we have is leadership and workforce strength. So great leadership and skilled employee can drive a company growth. So it's like a football team. If you have the best coach and player, you are more likely to win. And the next 8th point we have is you look at the financial performance and profitability, right? So finally we check, so you look at the financial performance, you look at the profit margin, right? So basically we check the company earning, profit margin, a return on investment, ROI. A business that generates high profit with a smart investment strategy is valued higher. So just like buying a car or a house, valuing a company required thorough research. You compare its position, strength, financial health before determining its worth. So in the next slide, we will apply this concept to the real world example. So let's see, identifying business that are analogous. So this is all relative valuation is all about. I hope this makes sense to you. So friends, now let's discuss our next slide. So let's say you are buying a phone. Let me give you an example, right? Let's say that you are buying a phone, okay, smartphone. So you would not compare an iPhone with a budget Android, right? You look at the similar model with same feature, brand positioning and price range, right? So that is exactly how we identify comparable business in relative valuation. So basically we are identifying what? Comparable business. So please tell me whether you are buying a phone, so do you compare iPhone with an Android phone? No. What you do, you look at the various Android phone with the same price range, with some brand positioning, right, and with the same feature and price range. That is exactly how we identify comparable business in relative valuation. So once we analyze the company we are valuing, the next step is to find similar business for comparison. So first of all we have to analyze which type of company we are valuing, right? So now we know that yes, this company we are valuing. The next step is to do is to find similar business for comparison. But here is the catch, it is not as easy as it sounds. Let's break it down step by step. First thing to look at, this is step number 1, you look for similarities, which means just like comparing phone with similar processor, camera, display, we look for company in the same industry, right? We look for company in the same industry, same customer base and operational scope. So we look for those company which is in same industry, same customer type, same operational scope. That is how we find the company. Then second thing is finding the right matches is tough, right? It can be challenging to find the exact match. Business often have different product, different strategy, so finding an exact match is rare. So instead what analysts do, they select about 10 to 15 company in the same industry and narrow it down to 3 to 4 closely related one, right? So they select 10 to 15 company and they narrow it down to 3 to 4 company. This is how they do it, right? And the role of experience also play a very important role, right? So picking the right comparable is an art. A seasoned analyst can spot the best match. So here comes the role of analyst, right? Experienced analyst. So a seasoned analyst can spot the best match while a beginner might struggle. So that is what separates the pros from amateur, right? So the step number 4 is dig deeper into comparable, right? After creating initial list of comparable, you conduct further research, which means you dig deeper. It means that once we have a list, we research each company further by asking question like, why is this company valued higher or lower than its peers? Does it have better product? Does it have a strong brand? Does it have more loyal customer? Are its revenue stream diverse or dependent on just one product? So these questions we answer. And step number 5, understanding the difference. So even within the same industry, company may have different valuation multiple due to factors like economic of scale, brand strength and financial health. So even within the same industry, company may have different valuation multiple. So different valuation, so you should understand why multiples in the same peer group are different. So why valuation multiple are different, right? So just like you would not compare an economic car to a luxury sport car, so business should only be compared to the truly similar one, right? Compare to similar one, right? So finding the right matches is the key to accurate valuation. So I hope that if you found this explanation helpful, please hit that like button and subscribe for more easy explanation. So this is how we do the valuation of the company. This is how relative valuation is done, right? A comparable business is identified. Now what are the factors which plays role? We have just discussed now. Now let's talk about the multiples. So imagine you are shopping for a house. You would not just look at the total price, you will compare the price per square foot, location and feature, right? That is exactly how business are valued using multiple. But what are these multiple and how do they work? Let's break it down. So when analysts value a company, they don't just rely on one number. They use different multiple to compare it with similar business. And these multiple fall into two major categories. So there are two major group of this multiple. The first is called stock valuation multiple. The first is called stock valuation multiple. What does it mean? So these focus on company's share price in relation to the financial metric. So it focus on company's share price in relation to the financial metric. Company's share price in relation to the financial metric. So the common one, let me give you the name, like price earning ratio, PY ratio. We call it, in short, we call it PY ratio. You know what it is? So a company stock price to company profit. Earning is just a profit, and price, you know, company stock price is price. Then price book value ratio. So it is regarding comparing a stock price to the company net asset book value. Price sales ratio, it means compare stock price to total revenue. So this is the first category, that is called enterprise valuation multiple, sorry, stock valuation multiple, which means it focus on company share price. So you see in all these ratio, price in the numerator, so we are comparing the share price. That is why it is called stock valuation. We are comparing the share price of the company with respect to other financial metrics, like maybe earning, maybe sales, maybe book value. So these are the different financial metrics with which we are comparing our sales price, sorry, stock price or share price. And the other kind of multiple we have is called enterprise valuation multiple. So this focus on overall company value. So instead of share price, it focus on the enterprise value, overall company value, not just stock price. So popular one includes EV upon EBITDA. So you will see in the numerator always you will see EV. EV means enterprise value. Here you can see EV upon FCFF, EV upon book value, EV upon sales ratio. So EV upon EBITDA, if we talk about it, so what does it does? You see, it compare the company total value or enterprise value to its earning before asset, tax, depreciation and amortization. What is the meaning of EBITDA? EBITDA means earning before interest, tax, depreciation and amortization. EV upon FCFF, which means EV upon free cash flow. EV upon book value, which means compare total value to the company net worth. And EV upon sales, which means it look at how much company is worth related to its sales. So these are the two broad category in which the entire multiple have been divided. The first is called stock valuation multiple, second is called enterprise valuation multiple. Now the next question is, why we use multiple multiples? Why multiple multiples? Just like checking multiple factor before buying a house, analysts don't rely on just one multiple. They typically use 2 to 3 different one to get the most accurate valuation, right? So suppose you are buying a house, right? So you check the multiple factor before buying a house. Similarly, analysts don't just rely on one multiple. They typically use 2 to 3 different one to get the most accurate valuation. Now, so what are the some most commonly used multiple? Let me give you some example. So commonly used multiple, you know, is EV upon EBITDA, EV upon book value, EV upon sales ratio. These give a well-rounded picture of a company financial health and market standing. So think of valuation multiple as different lenses to view a company worth. The key is to pick the right one depending on the situation, right? So in the next slide we will apply and real life world valuation. So you can see figuring out the various multiple for other comparable company. So now we will do some numerical. So have you ever wondered how company are compared to find their true value? Suppose we want to find the true value of the company. So how do we compare company, right? So let me give you an example to make it more clear. Imagine that you are comparing to a smartphone, right? Suppose you have two phones and you are comparing them. So you check battery life, you check camera quality, you check processor speed. Similarly, you know, in the business valuation, whenever we value the business, right, so we compare company using some multiple which we call financial multiple. So we compare company using financial multiple. So let's break it down in the easiest way possible. So when valuing a company, we look at similar business, we look at similar business and calculate valuation multiple using financial data. So whenever you are valuing a company, we look at similar multiple and calculate valuation using financial data. So let's take two company A and company B, and let's see how it works. So friends, company A, here are their financial data. So for company A, you can see that sales is how much, 6,000 crore, EBITDA is how much, earning before interest, tax, debt and amortization, depreciation amortization 1,000 crore, book value of asset 4,000 crore, enterprise value 3,000 crore. Similarly for company B, the data has been given 9,000, 2,000, 6,000, 4,500. So now let's calculate the valuation multiple. So you can see if we calculate the EV upon EBITDA, so EV means enterprise value. Just put 3,000 in the numerator and 1,000 in the denominator. So for company A, you get this ratio 3. Similarly for company B, 4,500 upon 9,000. So it will be how much? No. 4,500 upon 2,000. It will be 2.25, right? So average, if you find the average, you just add by them, divide by 2. This will give you the average, which is 2.625. Similarly, for the other kind of ratio, suppose EV upon book value. So EV 3,000 upon 44,000, 3 upon 4, which is 0.75. And for company B, it is 4,500 upon 66,000, which is 0.45, which is nearly equal to 0.75. Average is also 0.75. And the third ratio we have is we have EV upon sales. So 3,000 upon 6,000, half. 4,500 upon 9,000, half. So average is also half. So this is the valuation multiple. Right, I hope this makes sense to you. So it means that if you are valuing a third company, you could compare it multiple with this average to estimate its market value. So you can look at this average value, right? You could compare the company with this average value. So if you are valuing a third company, suppose these are the two companies, the data you have taken, and you are valuing the third company, you could look at this average value to compare it multiple with the average value, right? So now let us look at what this multiple means. So first of all, let's talk about the EV upon EVI TDA. So EV upon EVI TDA measures profitability. So this first ratio which we have just talked now, it measures what? Profitability. Then we have EV upon book value. So what it does, it shows the how the company worth compared to its asset. That is called book value. How the company worth compared to the asset. EV upon sales, it's check how much the company is valued compared to its revenue. So sales generally means revenue. How is the valuation of the company compared to its revenue? That is EV upon sales. So by comparing multiple, analyst can judge if the company is overpriced, underpriced, or fairly valued. This simple technique is a game changer in the financial analysis. Now let us discuss the establishing a value for the concerned business. So what does it mean? What is the meaning of establishing a value? How do we put a price tag on a business? That is the question. How do we put a price tag on business? Right. So imagine you are buying a car. Suppose you are buying a car, right? So you check prices of similar model, right? You check the prices of similar model, right? You compare the mileage. You check the condition, you check the brand reputation before deciding what it is worth. So the same logic apply in business valuation, right? So let's break it down in the simplest way possible. So when valuing a company, we don't just pick a random number, we use some valuation multiple, right? So there is something called valuation multiple which is used. We use something called valuation multiple of similar business to estimate a fair price. So we use valuation multiple of comparable company to estimate the fair price, right? So this is how we do it. So let us look at it step by step. First of all, you compare with a similar company, right? You compare with the similar company. Look at the business in the same industry with similar size, similar market presence, and you compare their revenue, profit margin, financial ratio. That's it. So this is the first step. That is called compare with similar company. That is called compare with the similar company. Second step is that you apply the average multiple. So remember this EVI TD. You remember this EV upon sales. You remember this EV upon value. So basically remember this value we calculated earlier. So we apply those averages to the company we are valuing to get an estimated price, right? And then we refine the estimate. The third step we do is refining. Since no two businesses are identical, so we adjust for some difference in growth prospect, right? So we difference in the growth prospect. So is our company expected to grow faster or slower? We look at the risk factor, which means is it riskier or safer than the other? We look at which means does it operate on a bigger or a smaller scale? So these factors, right? These factors we factor in. So basically what we do, since no two businesses are identical, so we adjust for difference in growth prospect, risk characteristics, and size, and use judgment for the final valuation. Then we step judgment. What it means, once we have multiple estimate, we take an average for a balanced valuation. Analysts use experience and market insight to fine tune to the final figure. So let me give you an example of all these four steps. So let's suppose a real estate deal. If similar apartment in the area sell for 1 crore, so you want to do a similar one. You compare location, amenities, size before deciding its fair price. So business valuation works the same way. So valuing a business is a part science, part art. You need data, but you also need judgment and market understanding to get it right. So if you want to master the valuation technique, do like, share, and subscribe the channel, because I will help you master this technique using this particular chapter. So now let's look at some values. Let's look at some illustration in your book. So friends, hopefully theory portion is clear. So how do we put a price tag on our business? Again, our question remain the same. How to put a price tag on a business, right? So let's say you want to sell your house. You check price of similar home in the area. You compare size, you compare location, you check amenities, and then decide a fair value. But what if it is a business instead of the house? That is where relative valuation comes into picture. So let's break it down step by step with an easy to follow example. So here we have M. Let's understand it financials. So we have a company called M, and we want to determine it EV. What is the meaning of enterprise value? That is the total value of the company. I told you, right? So let's look at some data like TDA, which is earning interest, tax, depreciation, amortization, which is 500 crore. Book value of asset is 2000 crore. Sales, which is the revenue, which is 5500 crore. So you can think of this number as the key ingredient that help us cook up the valuation. These are the key ingredient based on which we can cook up the valuation. Now this is the step number 1. Step number 2 is to value company M, right? We compare it with similar business in the same industry. So we have three business. We have 3 company available. Similar company E, company F, and company G, right? And the data for sales data, EBI, TDA data, book value data, enterprise value data is given. You can see this data. This data we have collected for these 3 companies. The data has been given, right? So these company help us estimate that what company M should be worth. So we have data of 3 company, right? Now let's see how we apply the relative valuation technique. Now we use something called valuation multiple, right? So we find the valuation multiple for all these 3 companies, that is E, F, and G. So how do we go about? So think of multiple as a price tag. You can think of this multiple as the price tag for different aspect of the business. So first multiple we have is EBI TDA. It measures how much investors are willing to pay for its profit, right? And the second is EV value. It measures it checks how much value the company has it in asset. E on sale means it compare company value to revenue, right? So how do we get all these value? Quite simple. Let's look at for company. Let me zoom out a little bit so that these 2 picture come on the same slide. Now you look at it. So suppose I want to calculate the EV upon EBI TDA for suppose a company E. So what is EV? EV is 3000, and what is EBI TDA? 400. So 3000 upon 400, this will give us 30 upon 4 or 15 upon 2 or 7.5. So this 7.5 is written here. I hope this makes sense. Now suppose I want to calculate EV upon book value for company E. So what is EV for company E? 3000. What is book value for company E? 900. So 3000 upon 900. So this will give us 30 upon 9, or this will give us 10 upon 3, which is approximately 33, right? So this is 3.33. So this way we calculate these ratio for all these 3 company. I hope that is quite easy to do now. So now data that I have put in this particular table, right, as you can see it clearly. Now the next step is to calculate enterprise value for company M. How do we go about calculating the enterprise value for company M? And also one thing I want to tell you that we make a separate column for average value. How do we get the average? You add all of them, divide by 3. You add all of them, divide by 3. You add all of them, divide by 3. This will give you the average, right? Now let's switch our focus to calculating enterprise value for company M. Now let's compare company M value using average multiple, right? So average multiple just we have put this value. You see this value we have put here: EBI TDA, book value, and sales, right? So these are the average multiple. So basically average multiple is known, and some financial figure we know the what is the EBI TDA of company M. I think we already told you. I told you earlier. You see the company M EBI TDA is given 500 crore. Let me write it down. EBI TDA is 500 crore. This we know. We have company M for we know the book value of asset is 2000 crore, and we know sales is how much? 5500 crore. This value we know for company M. Now what we will do? We will multiply the average multiple to get the exact value. So how do we do it? So what is the EBI TDA for company MM? 500 crore. So just write 500 crore and just multiply it with the average multiple, which is 12.75, and after multiplication you will get 6375 crore. So this is the estimated value, EV value, based on EBI TDA. Then book value. So what is the book value? 2000 crore. You multiply it with the multiple, which is 5.165. So 5.165 multiplied by 2000. This will give you 330 crore. Similarly for sales, if you take sales as the basis, right, sales as the basis, so EV upon sales is how much? 3.5. So this 3.5 has to be multiplied with the sales, actual sales, which is how much? 5500, which will give you the EV. Simple, it is simple. You see EB upon sales multiplied by sales. This sale will get cancelled, ultimately you will get EV. So finally we get the enterprise value, right? And if you take the average, how do we get the average? So you add all of them, divide by 3, you will get the average 11985 crore. So this is the average. So just like you would not pay double the price for a similar car, business also need fair valuation, and this method ensure investor don't overpay or don't undervalue a company. I hope this makes sense, quite easy to understand, right? So the final enterprise value is 11985. This way question can be asked and you can easily answer. Now let's look at some multiple now, which is first multiple is PY. Have you ever wondered why some stocks seem expensive while other look cheap? You might have seen the stock value. Some stock are expensive, some look cheap. So the PY ratio is like the price tag for the stock. So if we talk in the simple way, just wait a minute. If we talk in the simple way, so we can say that this PY multiple is just like price tag for a stock. This is just like a price tag for a stock. So the PY ratio help investor decide whether a company is a good buy or a overprice. So whether a company is a good buy or whether it is overpriced, right? So today we will break it down in super simple way, so that by the end of this slide you will be able to analyze a stock like a pro. Now the first question is, from where did this PY ratio come from, right? So originate, what is the origination point? How does it originate? Let's go into history. So PY ratio is not just another finance buzzword. It has been around for nearly a century. It was first introduced in 1934, by two legendary investors, Benjamin Graham and David L. Dodd, right, in their book called Security Analysis. So why does this matter? The next question is, why does this matter? Why it matter? Let's answer it. So because these two are the father of value investing. Their ideas laid the foundation for legend like Warren Buffett, right? So their idea laid the foundation for legend like Warren Buffett, right? Yes, the guy who made billions by picking great stock. Now the second question is, what is PY ratio? What is PY? So I hope the origination is clear. From where is originated? So imagine you walk into electronic store. So let me give you an example. This is the simplest example using which you can understand this PY multiple, and this is very helpful in the stock valuation, right? So imagine that you walk into an electronic store looking for new laptop. You are looking for new laptop, right? And you see one is priced as rupees 50,000 and other is priced as rupees 1 lakh. Okay, 1 lakh. Fine. So before deciding, you check their performance. What you check? You check their performance, right? Which one give you the best bang for the buck? That is exactly how PY work for a stock. It tells us how much investors are willing to pay for every rupees one of company earning. So it tells us how much investors are willing to pay, right? How much will they pay for every 1 rupees of company earning? That is called PY. So in the numerator you see profit, and in the denominator you see price per earning. So it is called market price per share upon earning per share. In simple word, we can say that if PY is higher, just like I have taken the laptop example, you see their performance, right? You see their performance and then you give the price. So if you look at the numerator of this PY, so it is simply the price at which a stock is trading today, right? That is called current market price. Which price at which a stock is trading? Current market price means the price at which a stock is trading today. That is called numerator. And if you look at the denominator, so denominator is earning per share, right? So earning per share, this can be based on the last year earning, right? It can be based on the last year earning, which is called historical PY. It can be based on last 12-month earning, which is trailing PY. It can be based on the this year expected earning, which is called forward PY, right? Or it could be based on the next year expected earning, which is called future PY. So it could be anything, right? So let me give an example. So let's suppose that if a stock is priced as rupees 200, this is the current price of the stock, rupees 200 per stock, it will cost you rupees 200, and it expected EPS next year, earning per share next year, means earning per share. So earning per share next year is supposed rupees 20, right? So what is PY? It's nothing but 200 upon 20, right, which is give you 10. So this means investors are willing to 10 rupees for every 1 rupees of earning the company generate, right? For every 1 rupees of the company generate, investors are willing to pay 10 rupees, right? That is the point. So two things are there. Company is generating rupees 1 earning, and investors are willing to pay 10 rupees for that. That is the point. So I hope this makes sense. Now why should you care about this PY ratio? So it helps compare stock, right? It helps you compare the stock. Just like checking laptop specs, it helps investor compare company. It tells you if the stock is overpriced. So if PY is very high, suppose if the PY is very high, it means the stock is too much expensive, because if PY is high, it simply means that investors are willing to pay more for 1 unit earning of the company. That means in stock is overpriced, right? It simply means that stock is overpriced, and it helps spot undervalued stock. A low PY could mean the stock is hidden gem. So we always compare PY ratio within the same industry. A bank PY won't be same as tech company PY. Remember it. So not necessarily. So final thought, is this high PY always bad? Suppose I ask you that suppose we have high PY, is it always bad? The answer is no, not necessarily. Sometimes company with high growth potential have high PY ratio, but that does not always mean they are overpriced. The key is to analyze earning growth, industry trend, and future potential, right? So now let's talk about some fundamental determinant of the PY multiple, right? So let's talk about it now. So friends, have you ever wondered why some company have high PY ratio while other have low one? What is driving this number behind the scene? Today we will break down the fundamental factor that determine a company PY ratio in the easiest way possible. By the end of this slide, you will understand how to calculate and interpret PY like a pro. What is the formula behind PY? So see, the fundamental formula of PY is 1 minus B upon R minus ROE into B. It looks scary, right? But don't worry, let's break it down in simple term so that it makes perfect sense. So what do this term means? First thing is 1 minus B. So 1 minus B is called dividend payout ratio. So this tells us how much of the company profit is given to the shareholder as dividend. So how much of the company profit is given to the shareholder as in the form of dividend, 1 minus B, right? And R stands for cost of equity. This is in the denominator. So the return investor expect for taking the risk. Obviously investors are taking the risk. How much return are they expecting? If investors think that stock is risky, they will expect higher return. Obviously बात है, obviously higher risk means higher return, so R will be higher. ROE is the return on equity. This measures how well the company is using shareholder money to generate profit, how efficiently. So company, this is company, so this is using investor money and they are generating profit. So how efficiently they are using company money to generate profit, this is noted by ROE, return on equity, right? And B, B is called plowback ratio or retention ratio. This is simply the part of profit the company keep for reinvestment rather than giving out the dividend. So the part of the profit that company keep at reinvestment, it does not give as dividend. So company with a high B is focused on growth. So let me give you some real life example to make this concept more clear. You can take example of V&S company, right? It ROE is given 20%, cost of equity is 15%, dividend payout is 3.3, retention ratio is 0.7. Obviously these are reciprocal to each other. So how to go about calculating PY? Quite simple. Just write down the formula. The formula is 1 minus B, which is dividend payout ratio, or 1 minus retention ratio, upon R minus ROE times B, right? B is the plowback ratio or the retention ratio. So in this case, what is our 1 minus B? So B is 1 minus 0.7, which is 0.3. 1 minus B is dividend payout ratio 0.3 upon R minus R is 0.15 minus this will give you 30, right? So this is how you do it. The final answer is 30. So what does it mean? So what does this mean? It means that if a company pay more dividend, so you see like this, if a company pay more dividend, which means this dividend payout ratio will increase. So that means 1 minus B will increase. So it means its PY ratio will be higher, right? Because company is paying more dividend. Because it simply means that for 1 rupees of company earning, right, how much investors are willing to pay, that is called PY. So since dividend payout ratio is more, so investors are willing to pay more, right? And if company reinvest some profit, that means if retention ratio is higher, its PY depends on whether those investment generate high return. So a company with high ROE and low cost of equity, so you see this ratio carefully, 1 minus B upon let me show you the equation, right? This is the equation. So 1 minus b upon r minus ROE times b, right? This r is, this r is the return on equity, sorry, cost of equity, and this ROE is the return on equity. So if a company has high dividend payout ratio, so this PYE will increase because they are proportional to each other. And if a company with high ROE, suppose ROE is high and low cost of equity, this is low, right, this is high, so what will happen, this entire value will become less, so PYE will increase. So it means investors are willing to pay more for its earning, right? Investors are willing to pay more for its earning. And if dividend are higher, so investors are willing to pay more for its earning. Per unit earning, how much investors are willing to pay, that PYE ratio shows you price per earning. So PYE ratio is not random, it depends on how much profit is given as dividend and how will the company reinvest, right? So this numerator, you see, numerator tells you how much the company is willing to give at dividend. So if company are willing to give more dividend, so investors are willing to pay more for 1 unit of earning of company. And second, in the denominator you see r minus ROE times b. It just shows you that how will a company reinvest, right? I told you earlier, right? So retention ratio, B indicates the retention ratio, that means how much company are willing to reinvest. So if B is higher, so this ratio will be smaller, so PYE will be higher. So if the company are willing to reinvest, so obviously this ratio will become higher. So I hope this makes sense. Return on equity, if ROE is higher, means return on equity is higher, so obviously the investor will be paying more. That is the point. Dividend high, if dividend payout ratio is higher, retention is higher. So you can remember it like this, very easy to understand. Once we have learned that PYE is directly proportional to 1 minus b, right? So it means if dividend payout ratio is higher, PYE is higher, and PYE is inversely proportional to R. R is the return on equity, right? So if return on equity is higher, so this become lower, so this become higher. That's how. So a high PYE means investor expect growth, while a low PYE indicate undervaluation or slow growth. Always compare PYE ratio within the same industry to get a true picture of the value. Now you know the secret behind the PYE. I hope you find this breakdown helpful. Please hit that like button. Now let's switch our focus. If you want videos such like this for each and every subjects of CAIIB, you can WhatsApp me on this particular number. We have videos of each and every subjects available, right? Now let's look at another valuation multiple, which we call PYE multiple. So I think I have missed something, that why we use this PYE multiple. I think, yeah, reason, this reason I have missed some. So let's talk about the reason. So ever heard people say this stock has low PYE ratio, it is a great buy, or PYE ratio is high, so the stock is expensive. But what do this number really mean, and how do they help in making investment decision? So why do we use PYE multiple? So price to earning is one of the most popular way to value a company. So the first thing is earning potential, right? So the higher a company earning per share, the more valuable is a stock. So PYE help investor understand if the stock is overpriced or a great deal. Second thing is real market trend. Studies show that a stock with low PYE ratio often outperform the market over the time. This means investor pay less for more earning, making this stock attractive, because investor pay less and they earn more. But there is a catch, the PYE ratio is not perfect, right? Because there are some challenges also. So earning can be volatile, the earning changes every quarter, right? So that is why this is not perfect, and company might have one time profit or other loss that distort the PYE. And there are some different accounting rule, different accounting principle. It means PYE ratio are not always easy to compare between company. So this PYE ratio is a powerful tool, but you must use it with caution. Look at earning consistency before making investment decision. Now let's switch our focus to the PYB multiple, right? PYE we have seen. Now let's look at PYB multiple. So the price to book ratio is another important way to measure a company value. But how does it differ from PYE? So PYE focus on earning, name itself say E for earning, and PYB focus on the actual asset. PYB focus on the actual asset, or we call it the book value. Now the question is, what is this book value? What is the meaning of this book value? Think of it like this. If a company shut down today and sell everything it own, the leftover money after paying debt belong to the shareholder. This is called book value. Suppose the company shut down today, right, and sell everything, whatever is it asset, sell everything. So whatever left our money after paying debt, it belong to the shareholder. So it has paid the debt, right? Whatever is the left our money, leftover money, right? That belong to the shareholder. It's called book value. And you know what is the formula for PYV? The formula for PYV is quite simple. Let me show you the formula. I hope I've written below, right? So the formula for PYV, you can see shareholder fund minus preference capital upon number of outstanding equity share. What is the meaning of shareholder fund? Means total money belong to the shareholder minus preference capital, means money reserved for preferential shareholder, and divide by outstanding share, which means total share currently held by the investor. So you know, this PYV ratio help investor understand if they are paying too much or getting a bargain on the company real asset. So quite simple to understand. If this PYV is less than 1, it means the stock is cheap, which means potential undervaluation. And if PYV is greater than 1, it means the stock may be expensive. It means investor expect high future profit, right? So this is the point. Shareholder fund minus preferential capital upon outstanding equity share. So the denominator is, you know, the denominator is book value per share, right? Number of equity share. So that is the point. Now the PYV ratio help investor understand if they are paying too much or getting a bargain on the company real asset. Now the question is which one to use, PYE or PYV? So PYE is great for evaluating company based on profit. You know, for those company which is based on profit, right? So for them PYE is great. So let me write down company which is based on profit. And PYV is better for a company with lot of asset. Some company, you know, have lot of asset, like a bank, like a real estate firm. So these company are having lot of asset. For them PYV is better. So if a company has consistent earning, use PYE. If company profit are unpredictable, PYV might give a clear sense, right? So a smart checklist, a smart investor checklist. So let me give you some way to when to use PYV, when to use PYE. So use PYV when you want to know if the company's stock price is fair compared to its earning. Sorry, PYE. If you want to look at if the price is fair compared to the earning, and if the company has a stable profit, right? As profit is stable, then you can use PYE. And use PYV when you want to check if the stock is cheap or expensive based on its actual worth, and the company has high number of assets. Use PYV. So we use both ratio together for better analysis. Now you know the real story behind PYB and PYE. So next time you analyze a stock, you will understand if it is bargain or overprice. If you look PYB, if it is greater than 1, it means it is overprice, and if it is less than 1, it means it is bargain. Now let's talk about the fundamental formula to calculate this PYB ratio. So here it is. Here it is the formula, right? So did you know that the company can report negative earning still have a valuable stock? This is where PYV ratio multiple comes into play. So most investors focus only on profit, that is PYV ratio, but PYV ratio help us understand a company true worth based on asset. So the formula of PYV is, you can see, ROE into 1 minus B upon R minus G, right? Sound complex, don't worry. So first thing is ROE. ROE is a return on equity, which means that measure how much profit a company make for every rupee of the shareholder money, right? So shareholder is suppose paying 1 rupee, so how much profit a company make, that is called ROE. G is the growth rate. So what is the meaning of this growth rate? So it means how fast the company is growing in profit. 1 minus B is dividend payout ratio, that means how much dividend the company is paying as dividend, how much the profit is given as shareholder as dividend. And R is the how much return the equity investor are expecting. So a high ROE and low return means a high PYV ratio, indicating the company is a valuable. So ROE is high, it means the company is generating more return for investor based on investment. So it means high PYV. And if required return is low, right? If R is low, right? So this PYV will be higher. So let's take an example of this Vithal Limited. ROE is given 25%, right? And rate of return is given 8%. Dividend payout ratio is given 0.5. Growth rate is given how much? 15%. So this P naught upon B naught is equal to 0.25 multiplied by 0.5 upon 0.18 minus 0.15 R minus G. So this gives you 4.17. What does it mean? It means that Vithal Limited stock is priced 4.17 times its book value, meaning investors are willing to pay more for every rupee of the asset that company own. This is the sign of a strong business with high return. So question is, why do investors use the PYV ratio? Because it is always positive, right? It is more reliable than PYE. You must remember that PYB is more reliable than PYE because it is always reliable. Means how much investors are willing to pay for 1 unit of the asset. So unlike earning, which can be negative, book value is always positive. and it is more stable, which means that book value does not fluctuate as much as earning. This makes PYB a better tool when EPS is unstable or unpredictable. And there is some proven link to long-term return. This is a proven link to long-term return. So study shows that variation in the PYB ratio often predict the long-term stock performance better than PYE ratio. So if a company has volatile earning or is in capital intensive in the industry like banking and manufacturing, PYB ratio is a more reliable nuts. Now the disadvantage is also, so PYE is better when company has consistent earning. PYB is better when earning is unpredictable. For bank, NBFC, for bank, NBFC, capital heavy industry, PYE is go to metric because they compare, this company rely heavily on asset and equity. So that is all about this. So now let's talk about some investment strategy, right? So let's talk about some investment strategy. As you can see, okay, so PYS, let's lose our focus to our PYS. So friends, that's all about the part 1 lecture. We will cover the rest part in the part 2 lecture. This will be available to the paid member. So if you want to enroll in our course, so you can get detail by WhatsApp me on this particular number. This is the number. Thank you.